Hey guys, hey, it's Daniel Lehman with the Lehman Group. So in any shifting market or in any kind of change in a market dynamic, it's really important to understand tools and concepts that can kind of help you go through it or better serve your clients better, or if you are a consumer, to better understand what your options are. So I wanted to share with you over the next little bit some of the concepts, starting with what I'm going to share with you right now is what's called the 2-1 buy down. A lot of people haven't heard of what is a 2-1 buy down. So I wanted to give you that and explain that in a way that makes sense, and also give you some dynamics of how they work and how you calculate a 2-1 buy down and how you quantify it. So in essence, what a 2-1 buy down is, it's also called a temporary buy down, because what in essence is happening is if interest rates are 6%, and you're locking a 6% rate, what a 2-1 buy down does is allow a seller or some kind of a credit to come in and make your first 12 months payments 2% under your market rate, your next 12 months payments 1% under the market rate, and then you're going forward, you're on a fixed 30-year fix. So I'm not talking about an adjustable rate mortgage that adjusts on a margin and an index. I'm talking about a 30-year fixed mortgage rate on whether it's a VA, an FHA, conventional loan at a fixed rate, but you're getting a temporary buy down for a period of time. So again, a 2-1 buy down would be first year is 2 points under, 2% under your market rate. Second year is 1%. So let me pull up my screen and let me show you an example of what a 2-1 buy down looks like, what that cost is, and some things that you can do as an alternative in your negotiations to make sure that you're getting the best deal possible. As an example, I'm using a $650,000 loan amount. I'm using a 6% rate. That's if the market is 6% today. And I'm using a 30-year fixed, 12 payments per year. And under those circumstances, you've got a monthly payment of about $3,900, $3,897. That would be your monthly payment, not including taxes and insurance, but that would be your monthly payment for that loan. As I described, what happens is in a 2-1 buy down, the first year, see how you're 6%? The first year, your rate would be 2%, 2% under that. So what would happen is at 4%, here is what your actual 6% payment is. Here's what your payment is at 4%. So in essence, there's a subsidy, there's a credit that comes in and gives you a $794, $794 savings on that payment for the first 12 months. The second 12-month period, the one in the 2-1 buy down, is a 5% interest rate. So that payment, again, your 6% payment is $3,897. That payment is $3,489. So your payment is still $407, $408 less than your 6% payment. So there's no real magic to how it works. In essence, what you do is you get a credit. And in this case, to simplify, I'm going to say you're going to get a seller credit, a credit from the seller in order to subsidize those payments. So we take this $793 a month for 12 months. That's $9,526. You take $407 times 12 months, and that's $4,892. So your total subsidy, the total cost of that buy down, is about $14,419. And you may be thinking, why would a seller subsidize me for $14,400? And the answer is because it's much more of a buyer's market now. And so what you're seeing in the market is you're seeing a lot of price reductions. So let's look at that. So if instead of a 650, we drop that to 635, that's a $15,000 reduction. Your payment only goes from $3,897 to $3,807. That's a $90 savings. In the buy down scenario, you get a $793 savings and then a $400 savings over the 2-year period. And if the market improves, which I think it's likely to do, and you're able to refinance lower, any remaining amount of that 2-1 buy down cost is credited back to you on your payoff. So it's not like you lose those funds. So in essence, this can be a really, really good way to take the same $15,000. And if you're a real estate agent, before you do a price reduction, talk to me and let's talk about the options related to a 2-1 buy down, because your buyers, your prospective buyers, it's probably going to be much more valuable to them to have a $700 or $800 reduction in payment for 12 months than a $400 to $500 reduction in payment for the next 12 months while we wait for this market to shake out, than $90 off due to a $15,000 price reduction. So hopefully that helps. Hopefully that helps you navigate this market or give your clients or give yourselves more options. If you have any questions about the 2-1 buy down, or if there's anything I can do to help, please just don't hesitate to reach out. Hope you're doing well, and have a good day.